Thank you everybody for joining us today. I hope everyone's doing well. My name is Cherish Dela Cruz and I am the founding partner of Dela Cruz Law. We are a boutique law firm that focuses on estate planning and business planning as well as elder law. We are located in Buckhead, but we also service Gwinnett County. Today we have Samantha Holowaka from Northwestern Mutual, David Hearn from Alvarez and Marcel, and David Verdugo from Bank of the Ozarks. Today, we want this to be a very interactive panel. So if you have questions throughout, you can raise your hand and we'll unmute you. Additionally, we will have a question and answer period towards the end of the webinar. But our agenda today is we are going to go over what estate planning is and what estate planning is for business owners. Then we are going to go over 7 steps to consider if you are thinking about selling your business. David Hearn is going to be talking about business valuations, and then Samantha is going to be talking about funding your exit strategy and how that works. This will be the first part in a series of webinars that we are putting together for small business owners and clients. Our focus today and what we have found in the last, in getting together, we see that there are a lot of small business owners who aren't necessarily aware of all of the options that they have, or they're not necessarily educated about the ways to create an estate plan, and then if they're thinking about selling their business 5 to 10 years from now, what that actually looks like. And so what we've tried today to do is to bring all of those areas together so that we could educate the small business owner. If there are other questions that you do want to ask, or you can always reach out to us afterwards. David, can you go to the next slide? So what is estate planning for business owners? It means the business owner wants to retain control of their business and their property. They might not necessarily be thinking about passing it on to the next generation right now, but that's something that they're thinking about in maybe 5 to 10 years. They want to give what they have, including their business, to the people that they love when they want, in the way that they want. They also are thinking about protecting their assets, both personal and business. And they want to save as much money as possible and for their family from taxes, creditors, and predators. When they're thinking about estate planning, they want to do this without any unnecessary costs or delay to their loved ones. A business owner is in a unique position because the business owner relies on their business to fund their livelihood. And so what this means is that their business funds their family's lifestyle. And so if something impacts their business, it ultimately impacts their family. So when we're thinking about estate planning, we're thinking about what are the priorities. If it's a family-run business, they're thinking about their family. They're also thinking about their business partner. What happens if the business partner isn't around, or that there's difficulty or conflict there? They also want to make sure that they're preserving wealth for themselves and then also for future generations. They want to save on taxes and fees. So the business clients that come to me, these are some of the common concerns that they have. They want to keep the business going if they become sick or disabled. They want to ensure that there's a plan for either the sale of a business, or if it's a family-owned business, to pass it along to family members. They also want to protect the assets of the business. They also want to protect potential beneficiaries' inheritance. So when they're thinking, if it's a family-owned business and they have children that they're either thinking of passing it on to, they're able to do that in a tax-efficient way. And then also thinking about their own unique circumstances. They're also concerned about protecting their assets. So they want to protect themselves from lawsuits. If they're in a business, they want to ensure that their business assets are separated from their personal assets, and that creditors who may be creditors of the business can't tap into their personal assets. They want to make sure that they also have safety and security, and essentially having peace of mind. Next slide, okay. And so what are the reasons to protect the assets? Mainly, 80 to 90% of small businesses in the country are generally family-owned businesses. And succession planning is important for all of those business owners, but for particularly family business owners. Less than a third of family businesses succeed into the second generation, and only 10% survive into the third. So what do we, myself as an estate planner and a business planner, we have to look and see what is going to happen with the business, and if the business owner wants to sell, what that looks like. And we need to coordinate with people like Sam and David Verdugo and David Hearn. And it needs to be a collaborative process. And we need to define the goals for the business owner. Next slide. Another concern that comes up with some business owners is divorces and bankruptcies. If there is a partnership where it could be a family-owned business, but there are two partners, what does a divorce look like, and how does it impact the business owner's ownership interest? And that's something that needs to be considered. Next slide. And we do all of our counseling, all of our business planning through meeting with all of the advisors as a team, and then also ensuring that we do this through counseling. Business planning takes time, and business owners should start thinking about it in terms of what their ultimate goals are. So if they want to sell the business in 5 to 10 years, they need to start thinking and planning and strategizing now, and implementing those things. There are differences in trusts. You can have a trust that is a revocable living trust, which you can change throughout your lifetime. And then you have an irrevocable trust, which is like a closed box, which means that you can't change it. I think we've gone over this part, but most of the business owners that I work with, they want to ensure that their children are protected. And so they want to make sure that not necessarily all of the money or the assets from the business are given to them outright. So we do planning with trusts. Business owners are concerned about protecting their children's inheritance, especially if they have a spendthrift child, which means that the child might not necessarily be financially responsible with money. And it involves putting conditions in the trust so that the child doesn't spend all of their money at one time. They also want to ensure that their children, if they are maybe getting a divorce, protecting their assets as well too. Can you go forward to the next one, David? Okay. So some of the benefits of doing outright ownership versus a trust. We need to figure out exactly if the child is responsible and if they can inherit, or if a trust needs to be created for that child. Some of the reasons why you might not necessarily want it to go outright to the child is because if they are irresponsible with money, they might lose property to a creditor or to a divorcing spouse. Can you go one forward? So another issue that I find with small business owners is how, especially if it's a multi-generational family business, we need to take into account how the aging process will impact the family and also the business owner. So looking at long-term care insurance, maybe Medicaid planning, and then we've also already discussed about the spendthrift child and protecting a children's inheritance from divorce and business failure. One of the questions that I always ask all of my business clients is, do you have a business succession plan in place? Even if you do have a business succession plan in place, are there actual mechanisms that are funding the buyout? Has it been properly drafted? Do they have a proper buy-sell agreement? Do they have disability insurance? And do they have life insurance? All of these are components to a good business planning strategy. Next. This is the case that I see a lot with business partners. They do not have a buy-sell agreement. A buy-sell agreement protects each other's interests. So I'll often see a business owner who has gone into a joint venture with one of their best friends. The business is doing well, but they don't take into account how a disability or a death would impact them. So what usually happens is that the business owner will have to sell the business because of this life event. So if somebody dies, then the business won't operate as a result of that because they don't have any money to fund that.
Mm-hmm. Cherish, this is Sam. I want to chime in on that if that's okay. We have a client who actually went through the situation with disability and then inevitably, unfortunately, led to the death of the owner of the company. And thankfully, they were well planned. We definitely have seen probably more cases where the buy-sell agreements are either not drafted or not funded properly, which would result in a sale of the business or liquidation of the business. And if it's a sale, it's usually at a discounted price, which we don't want, right? But in this particular situation, our client had planned very well in advance with his business partners, was diagnosed with terminal cancer early in life, had small children, not a lot of liquidity in the business either. And the planning that he did around disability had allowed him to spend the last 18 months of his life with his family and allowed his partners to buy out his family pretty seamlessly at the time of his death. And so everybody was made whole because of the planning that he did. And he actually became quite an advocate of the work that we did for him and encouraging other business owners, because his wife was in, she was in support groups for other people who had this type of cancer event in their families. And most of them were just trying to mortgage the house to pay medical bills. Or less what's going to happen when this person passes away or what's going to happen to my business. So when the business, like you had mentioned, is the biggest asset and really driving the lifestyle of the family and the financial security of the family and everyone in the business as well, it's really important to take the time to get these buy-sell agreements and exit strategies down. So I just wanted to chime in and share that.
No, I think that's great. So when did you start working with him? When he got sick, or?
No, when shortly after the business had started, it was more in the construction phase, and they really were not. It had grown over time, and so when we started working, it was just really doing some personal planning, but then also working on the business side as well as things got more complicated and as the value of the business grew significantly, right? It wasn't just something they were doing out of their garage anymore. So when it got to the point where it was like, wow, we really, if something were to happen, everybody here would be affected very negatively. And, we started these plans about 8 years before the event, and he died of cancer at 39.
Oh wow. Yeah.
So very unexpected, and he was also of the temperament of nothing's ever going to happen to me, I'm bulletproof kind of mentality, but we were able to convince him to think about the other folks, and so it was a very impactful case.
Thank you. And I've seen that situation as well too. but I've seen the opposite side where, there are businesses that haven't planned ahead, and the business dissolves as a result of not planning. And so, it's somebody who does get sick, or somebody who gets in a car accident, and the business the business owner didn't have any life insurance. The business owner who had a partner didn't prepare, and the family was at a loss. And now, the family beforehand, the wife wasn't working. The business owner, was the breadwinner, and she had to continue to work even though she was grieving and had all of these things going on. But she had to go back to work because there was no planning done on that end.
Hey, Cherish, just one quick note. Can you speak up a little bit? I got a note from a participant that she can be.
Okay. No, I was just saying that I've seen the other side, and I'm sorry, I wasn't speaking up. I've been on the other side of that, where the business owner didn't plan, and he was the breadwinner of the family, and he had a partner. The business eventually dissolved. The wife had to go back to work after her husband's death, even though she had 3 young children to take care of, because the business owner didn't plan. And so in thinking about this, you have to think about, who is it going to really impact? It's going to impact your business partner, who you may have been in a business relationship for, 30 years or 20 years. And, it's going to affect your business partner. And what does that mean? Is the business going to dissolve or not be able to function without you? And then it's ultimately going to impact your family. And most family business owners that I know, the reason that they work so hard and that they're, committed to their business is because they want to provide for their family. So just in thinking in terms of, why would you want to do a business succession plan or a buy-sell agreement? It's more than just the business. It's ultimately who you want to care for. David.
All right. So thank you, Cherish, for that. And I guess the moral of the story is just make sure that, we have a plan in place. And so, kind of with that being said, can you guys see my screen? All right.
Yeah.
Are you seeing the PowerPoint or?
No.
No, you're not seeing it.
Desktop.
All right. Let me try something real quick. I'm sharing this. There we go. Okay. So my name is David Verdugo. I'm a commercial banker with Banco CK. We are a regional bank based out of Little Rock, Arkansas, currently with about $22 billion in assets, about $17 billion in deposits, and $16 billion in total loans. We have a total of 66 branches here in the state of Georgia, and we're going rapidly. And part of what I do is I help business owners manage their banking needs and their financial needs as their companies are growing. I deal primarily with established businesses, usually companies that have sales anywhere between $1 million up to 300 million, and that have credit needs of somewhere in the neighborhood of about 500,000 all the way up to $50 million. But what I want to talk to you guys about today is just, all right, so you worked this hard, you've gotten to a stage where either you want to retire, you want to transition your business to your family, or you just want to sell your business because you're trying to get some accessibility to cash or diversify your investment. So what do you do from there? And so, talking about that a little bit, I guess when we were putting this presentation together, 7 steps kind of came up to our minds, and one of them being, prepare your exit strategy in advance. I think that we got a really good taste of that from Cherish conversation. Clean up your business financials. A lot of that has to do with, making sure that you get the most value out of your company. For the most part, it also means understanding what those financials look like. You'd be surprised how many of the people that I deal with on a day-to-day basis sometimes don't understand what their balance sheet or income statement's telling them, and how many of them would refer me over to their CPA for what I consider basic questions about their business. And a lot of that's, it's okay, but when you're going through the process of selling your business, sitting down with a potential buyer, you're gonna want to be well versed on what's going on with your financials and what's going on with your business. And those opportunities of selling your company could come from a couple of different ways, right? It could be a sale of to your employees. So the people working for your company may want to come in and buy the business from you. You may have an opportunity to put it in the open market. A competitor may be coming in and wanting to do a friendly buyout, or it could be just a straight acquisition from like a private equity investment firm or something to that effect. Boost your sales. That's easier said than done, and so we'll talk a little bit about that. Determining the value of your company, and part of our presentation today is going to be driven us to, what are some of the different indicators that valuation companies look at when they're trying to figure out how much your company's worth. Then find a business broker, getting in together with a group of people that understand what your needs are is always important. Pre-qualifying your buyers, and I'll talk a little bit about, what those buyers have in terms of opportunities to be able to pay you the money that you're asking for, and how that capital to pay you for the acquisition is going to be raised. And then finally, we'll talk about the get the business contract in order. So making sure that you have a good attorney in place to help you out with that contract. So prepare your exit strategy. So time it well. We all know that the economy is cyclical. We've been in a period of almost 10 years of constant growth. And a lot of the economists out there are kind of telling us that this thing can last forever. A lot of us saw the financial collapse of 2008. And so if you were selling your business back in 2008, the value that you would have been able to get from it would probably be a lot lower than what you could get for your business today. So always hope for the best, but be prepared for the worst. Sometimes financial collapses do happen. Perception is reality. What I mean by that is that people don't normally buy when your sales and revenues are in decline. So, and it also kind of applies to just banking in general. So if you're going out to your banker and you're asking for money, and all of a sudden your sales are declining, or your net profitability is declining, that banker or that buyer is going to ask a lot of questions, and that's going to diminish the value of your company. Diversify your income sources. A lot of, not a lot of the clients, but sometimes I do run into situations where you may have one client that represents a big chunk of your revenue, and that could present a problem both from a purchase perspective, but also from a lending perspective. So just consider your sources of income, and it goes in a couple of different ways, right? It goes into your client base, but it also goes into your employee and your products. And what I mean by your employees is you may have a sales staff of 10 people, but if 80% of your production is coming in from just one employee, that's great for him, but that's not primarily beneficial for your business, because if you do lose that one employee, then what's going to happen? And so a lot of that's going to be looked at during that business valuation. Eliminate the fluff. So what do I mean by that? A lot of business owners have a tendency of just adding expenses into their business that sometimes are very well-deserved expenses that should be part of their business, but sometimes there are just things in there that have a potential of decreasing the net profitability of that company, and therefore the likelihood of you getting a good multiplier from a business valuation perspective. And I know that David's probably going to chime in and tell you guys a little bit more about that. If you have any extra inventory sitting on hand that you probably could have gotten rid of 5-10 years ago, do that. That's going to give you a nice nice cash injection into your business. It's going to make your balance sheet look better, and it's also going to just present well from a buyer's perspective. Clean up your accounts receivables. So if you have accounts receivables that are over 90 or perhaps even 120 days, depending on your collection cycle, go out there and kind of negotiate with those clients that haven't paid you, and just make them a deal that they can't refuse. So, hey, if you pay me right now, I'll give you 20% discount. Again, it's going to clean up your balance sheet. It's going to clean up your AR report. It's going to give you a nice injection of cash, which is ultimately going to help you with your value of your company. So anyone buying your business will more than likely ask for financial records. Non-standard bookkeeping systems will make a buyer's life more complicated. So if you can simplify and you utilize standard bookkeeping systems, that's probably going to help out when it comes time to producing reports, and when it comes time for your buyer to transition into the new accounting system. Have a plan for outstanding business debt. If you have a loan with your bank, more than likely you're guaranteeing that loan personally. And what that means is that the bank is really invested in you as the individual. They don't know that buyer. They're not going to want to lend, or the likelihood of them wanting to lend over to that buyer is somehow diminished based on their experience, based on the level of comfort that the bank has with that particular buyer. And so more than likely, you're not going to be able to transfer that debt over to that individual. So just kind of take that into account and have a plan in place for that. Right. We talked a little bit about this. So remember that trends are your friends. And what I mean by that is that growth and profitability is something that's going to be scrutinized. So make sure that you're timing the sale of your business the right way, where the trends are going in the right direction, and you're going to be able to get the most bang for your buck. Be ready at all times, and you never know who's watching. I mean, there's people out there that are constantly coming up to business owners and saying, hey, you're interested in selling your business, and if so, you want to make sure that you have your financials in place and in order, so that you could get the best benefit out of that situation. Boost your sales. So make sure timing is right and sales are headed in the right direction. The stronger your company's brand and recognition is, the better. Optimize your systems. If there's a faster way to get things done, implemented, and then that's the company run without you. So, sometimes what I've seen is that business owners end up being the business as well. instead of them running the business. So you want to make sure that you're comfortable delegating, that that you seek advice from experts. One of the biggest mistakes that I've seen clients do is they get themselves into a situation where their business gets too big for their understanding of how to manage the company. And so, sometimes it's okay to go out and ask for advice and get the help of other folks, including, maybe hiring a CFO or hiring a sales officer to kind of help you out with boosting your sales, or a marketing officer that's going to help you with the reputation of your company. So pre-qualify your buyers, understand their sources of funding for the purchase. So you have one goal in place, and that is you want to get paid, you want cash. The buyer wishes they had cash to pay you in full, or, to be able to buy that business from you. But the reality is a little different. So there's a couple of different sources of financing for an acquisition. You'd be surprised, but probably one of the most common one is seller financing. So that means if you're the owner of the business, you're providing some kind of terms to that buyer for that acquisition. Bank financing, and then private equity funds. So if you're seller financing, your buyer would more than likely is going to give you a down payment, let's call it that, to make you feel comfortable that they mean business and that they're invested into making sure that that company is going to continue to produce. Because if it doesn't, then they're going to lose the money that they just put in as that down payment. But then in turn, they're going to come up to you and ask you to perhaps give them a loan for a particular dollar amount, or finance the rest of the acquisition based off the cash flows that business is going to generate. So you're acting as the bank. And so if you're acting as the bank, you're going to want to make sure that you're doing your due diligence, and that you understand who that buyer is, what their expertise in that market is. And you're going to want to understand what the sources of that cash that they're giving you as a down payment is coming from. So just make sure that you're asking some questions, and that you're seeking advice, whether from your banker, your attorney, or your CPA. Those guys would more than likely have had done something like this in the past, and would be able to provide you with some good feedback. The down payment's negotiable, but that's typically somewhere around 30%. The remaining amount is set up as a promissory note, and it typically has a length of anywhere between 3 to 5 years. And the note is usually taken out by a bank or private equity firm. So that 3-year mark, we hear a lot about that in banking. So when you're starting a business, if you're going out and you're trying to get a loan, you're hearing, hey, I want to see 3 years worth of financials. Well, in this particular situation, if you've had your company for a while, the financials are there. But then what we want to see as bankers is we want to see that the new management has the ability to continue to sustain the level of sales, or the level of profitability that you've had in the past. So that's why those notes on the seller financing side are typically done on a 3 to 5 year mark, just to kind of provide some cushion. And then usually after that, the seller or the buyer is able to prove that they have the ability to run the business. And so we as bankers feel comfortable with lending money to them. As far as the other option, right? So the buyer decides that they don't want to have you, the business owner, involved in the picture. So they come up to us and they want to finance the acquisition. Banks, for the most part, we're cash flow lenders. So we want to make sure that the business is generating enough cash flow for us to be able to be repaid back. But not only are we cash flow lenders, we also want to have a plan B and a plan C in place in the event that things don't go the way that we're expecting. And so the plan B is going to be the collateral. So what's being pledged as collateral for this acquisition? And then the plan C is going to be your credit worthiness. And so you will more than likely hear that being referred as the 3 C's of credit. There's the 5 C's of credit, but for the most part, the 3 C's, which is cash flow capital, cash flow collateral, and credit worthiness are going to be the most important things that we look at in the banking world. And so since we're financing hard assets, we want to make sure that when we go out there and we do evaluation, that there's enough value for us to be able to lend money on. So if you're buying a house, typically, the bank's not going to finance 120% of the acquisition of that property. Well, same thing applies to a business. If you're buying a business, we're not going to finance 100% of the acquisition or 100% of the hard assets. We're probably going to finance anywhere between 70 or 80%. And the thing with acquisitions is that there is an intangible value. So you got tangible assets and intangible assets. And so the intangible part is that reputation, that lengthening time in business, things that we don't have a way of collateralizing. And so for that, we typically use a program called the SBA 7A. So it's a government guarantee program that kind of comes in and says, hey, we'll help out with this acquisition, and we'll be able to finance some of those intangible assets. And the typical structure for that would look like 30% equity from the buyer, and then 70% bank's contribution. And the length of time for the loan is going to be dependent on the life of the hard assets. There's some flexibility with the 7A program, and so if you guys have more detailed questions about that, I can get into that offline, or you can send me an email. But so the 7A structure, just to kind of touch briefly on that, who's the 7A? The 7A, who's the SBA? The SBA is the Small Business Association. The 7A program is just one of the programs that they offer, and they help companies or business owners go out and do business through the process of guaranteeing some of the loans that they're making. So their SBA guaranteed is up to $5 million. You got 25 years based on acquisitions. And then under new bank rules, they can finance up to 90% or $500,000 of goodwill. So with that, I'll turn it over to David.
Thanks, David. Let me share the screen. Let's see. All right. Thanks, David. Yeah, no, I think a lot of what you shared is a really good segue into what I'm going to be talking about. First, I want to go ahead and thank all our attendees for dialing in today. I know time is our most precious commodity, so I'm really appreciative. And we're a little behind schedule, so I'm going to do my best to kind of fly through this. So if it feels like I'm talking at 100 miles per hour, it's kind of on purpose. Everyone on the call, if we haven't already said, is going to get a copy of all our slide decks. And so there's a lot of good nuggets in there, and you're obviously going to get all of our contact info. So if we don't end up answering questions or hitting topics that you saw, or we only briefly hit on them, just know you'll be able to get in touch with us. So with that, let me kind of jump in and segue into valuation. Obviously, we've kind of framed this up more on a exit or succession planning context. But really what I want to do is basically do two main objectives. One is to kind of give you a little more on the why. I know we've done a really good job at hitting the succession and exit, but I just want to point out a few of the other most common triggers of where you may come across valuation at some point in your life. And then kind of slowly segue into the how. So once you've done, everything that Cherish and David has talked about so far, how does that translate into what we call enterprise value, and how we value you? And so I'd like to spend most of my remaining time talking about the two most commonly used methodologies for valuation. And if there's time, I'd like to hit on what's called valuation discounts, which is a very hotbed area. And there are entire books written on discounts. And in a 15-minute presentation, we're only going to get an inch there. So with that, let me just dive in. I'm kind of going to pass over kind of my bio, other than to say, I've got a face for radio, so that kind of explains why I'm on a webinar. Recovering accountant, and been doing valuation pretty much ever since. So I want to go back to kind of what I was saying in terms of these, quote unquote umbrellas of where you may hit valuation. Obviously, we've been talking about, almost an M&A type context where, either you have a natural successor in, it may be a child who's in your business, or it may not be a child. It may be, just a long-time employee, which is common. Or it may be true exit planning where you're not fortunate to have either option for whatever reason, whether they don't have the capital or they aren't mature enough or whatever. And so you may need an actual third-party buyer, which I kind of lump that under kind of exit planning. But so, David and his bank David Vertigo may, require an audit or a review because you've come to him for some type of debt financing for whatever reason. And so as part of that, he may, insist on an audit or a review. And there are numerous provisions within accounting principles or US GAAP that require valuations. So it's not me kind of saying, hey, you really should do a valuation. If you get an audit or a review, odds are if you're doing things like issuing stock options to your employees, buying or selling businesses, you're going to have things like impairment testing. David touched on intangible assets. That's another big hot area in accounting rules that require things to be valued, like proprietary technology, customer base, et cetera. So there's an entire litany of valuation related work within kind of the accounting umbrella. The other big area where you're going to come across them is sort of estate planning, which we're touching on some here, where, someone like Cherish is going to work with you to, set up certain trusts like she hit on. And there are valuation discounts that you can take advantage of, which I'm going to be hitting on at the end of my presentation, which enable you to really freeze your estate tax and allow high appreciation of your business to pass on to your loved ones, essentially tax-free, while all the time you're maintaining control of your business. You're not handing the keys over to your son or daughter who may not be ready yet. So things like that are kind of the usual suspects, if you will. And then the other thing I want to hit on is sort of, I call it, unhappy valuation, which is sort of claims in dispute. And this would be where, sure, you and your partners are things are going around hunky-dory and nothing bad is ever going to happen to you guys. And then, unfortunately, the old adage, the only ship that can't sail is a partnership, comes true. And, there's some type of dispute and somebody wants out. And typically that person that wants out is going to want out for top dollar. And the person that's staying behind is going to, say, hey, you're crazy, the business isn't worth that much. And so we get brought in to be an independent third party to kind of be that neutral and be that independent person to value the company, as a bridge between the two sides. And marital divorce is another big area where, someone gets divorced late in life. One may be the homemaker, and the other may be the successful physician or whatever business they own. And so oftentimes we're brought in by the family law attorneys to kind of be, again, that neutral third party. So again, I just wanted to point out that even though we're talking mostly exit and succession, there are kind of many other umbrellas that you may stumble across, that valuation may come up, and it may be brought up by could be your banker, it could be your financial advisor, it could be your attorney, it could be your CPA, and so on. So I'm going to skip over a few of these things. Really, I just wanted to hit on that there's all these different definitions of the framework from which I'm valuing you. So if it's a tax framework, then obviously I'm following things like IRS rules. I'm following things like tax court cases and what they say someone like me should be able to do or not do. In the financial reporting rule, it's sort of the SEC is that IRS version in my tax analogy. And US GAAP is sort of that analogy to IRS tax code type thing. So I just wanted to point out that depending on the purpose for which I'm doing your valuation, it may dictate whether I use or don't use certain methods or certain tricks of the trade. And so context really can kind of not necessarily dictate value, but it can definitely impact direction, is what I would say here. And so this kind of hits on what everyone thus far has kind of talked on. I think most people realize there is this great wealth transfer occurring, with something over like $30 trillion over the next couple decades, and it's already happening. But I did want to point out that a very big amount of that are true business assets. And like Cherish and David have already hit on, very few people have a plan. And I heard some fantastic, horror stories from Sam and Cherish. And those things, unfortunately, are not uncommon. They're very common. And I think we all know in latest news, people like Aretha Franklin, Prince, these are people dying without things like basic wills. And these are very, educated, successful, and wealthy individuals. And even more alarming to me is that literally only something like 10% of business owners have a true loved one to even potentially pass it on to. And so this is just meant to kind of precipitate the urgency of, you need to be thinking about these things and taking to heed some of the advice that's been given earlier. And the biggest thing is the earlier you can get going, the better. Everything David hit on his slides about improving sales, receivables and inventory, all those good points he made, go to this, because if I'm a buyer, I want you to have already done that. And not just already done that, I want to see a history. So, let's say you do some of those actions that David Vertigo recommended 5 years ago. That way, okay, we've got 2 years to see, okay, did my strategy of changing these things add to value via my business valuation? And not just that, then, 3 years later, when we're finally, hopefully finding a legitimate, very strong buyer that has a number in mind that's close to what you have in mind, they've got a pattern to look back and go, okay, wow, yeah, they enacted these changes several years ago. And not just that, it really is kicking off more sales. It's kicking off more cash flow. And so that gives me as the buyer more comfort when I buy you that I'm going to get a return on my investment. So the main point is the sooner you can get going on this, the better. It does take a significant amount of time to truly sell your business. Although there are exceptions where someone, a strategic comes out of the woodworks and that kind of thing. But the general rule is it does take time. And what I would want to point to from there is kind of the last bullet on this slide is in general, from what I've seen, it takes well over a dozen buyer inquiries to really get to one legitimate, what I call full priced offer that actually has a shot at closing. And so that does, to me, speak volumes about the earlier point of the sooner you can get going, not just in terms of I want to sell my business, but make changes to my business before I get to the actual sale point. The higher probability you're going to have of successful outcome, and the higher that number is going to be. I'm not going to hit on too much else. I think they did a good job at talking about sudden illness. My example that I don't think is any better than what Sam shared was, I have actually a friend whose little sister, this is a person I went to high school with, her little sister, who's only 33, 4 kids under 6, who lives in Utah, just got stage 4 lung cancer. and there is a business involved. And so, everybody kind of has the, it'll never happen to me thing. So I totally agree with earlier points that were made. But the only thing I would add is there is going to eventually come to a point, unless you're just willing to walk away from your business, which many business owners do. Unfortunately, too many do what I call attrition, where, they just kind of at some point start going down to 30 hours a week, and then it's 20 hours a week, and then it's, I just close down and my customers kind of go elsewhere. But you work too hard to build an asset that can, create a return for you. And so at some point along the way, there is going to be a time where, plus or minus, 100 or 200 grand to me is a big deal. Depending on your wealth status and lifestyle, maybe it's not. But in general, I think eventually a thing like a valuation, given the to me low cost, insurance you get from doing one, when it can swing your ultimate payout by 100 grand or more in either direction, because maybe if you're the one who's doing the buyout, you might want a lower direction. There's going to come a time again where you want a firm number and you want a neutral number. David mentioned business brokers earlier, and obviously, they want a commission, they want to sell you. And so they want to show a really high number, right? And so my job is really to be that neutral and be a conservative party to give you a really fair estimate on what you're worth. And so for the rest of my time, I just want to talk about the approaches to valuing you. This would apply to whether you're a business, whether you're a chair, or whether you're a piece of real estate. It's these same methods. 99% of the time, it's going to be the market approach or income approach, as opposed to the asset approach. That's really, think of that as just cost. And that's really limited to things like asset holding companies that maybe it's an LLC that chairs formed and it just holds stocks and real estate and stuff like that. Or super speculative tech type startups that they don't have any revenue, there's no earnings, so you can't really project out things like cash flow, and you can't really apply multiples and this kind of thing. So I'm just going to touch on the market approach and income approach. This is, if you had your business valued, 99% of the time, one or both of these methods are going to be employed. Unfortunately, every method has advantages and disadvantages. In the market approach, it's great because you're relying on actual market evidence. So people like me are either going to go out to the public stock markets, and I'm going to find as close to a company that does what you do as I can, and use their stock price info that you see on CNBC and Bloomberg to imply a multiple off their revenue, or maybe off their earnings, or other measures, depending on what industry we're talking about. The other thing I can do is go find M&A transactions that I've done. So if I'm an eyelash extension business, I can go out to these databases and find a history, thanks to people like business brokers that share the information, of other eyelash extension businesses that have sold around Buckhead, if you're in Atlanta, and use their sales relative to their earnings to try to imply these multiples. But again, it is industry specific. When you talk to different advisors, you're going to hear a lot of different rules of thumbs. I would be very careful with those rule of thumbs. Like David hit on earlier about the economy, we do move in cycles, and those rule of thumbs move with it constantly. So what might have been an old 4 to 6 times earnings kind of thing that you might hear, at the country club or wherever on the golf course, now, multiples are a lot higher with the way the stock market has gone, with the way the economy has gone. So it really does behoove you to kind of take a fresh look when you're doing this, and not to rely on those old rule of thumbs, even in some cases when they do turn out to be true. But then again, the only other point I want to point out is, if you're a hospital or a hotel, you wouldn't necessarily be using a price to earnings or price to revenue. You may have more industry specific multiples like price per bed, the cable industry, price per subscriber, et cetera. So in general, while the most often used are earnings or revenue type multiples, there are others depending on what industry you're in. I've included examples of all 3 methods, so I highly encourage you guys to go take a look at those. But you can see where I'm applying a multiple to a company's either revenue or earnings stream to kind of come up with a value. So I know sometimes when people, give lectures and that kind of thing, it's hard to really let it sink in until you've seen the kind of pen on paper. So I'm hoping those examples are helpful. And then the last approach I want to hit on before I turn it over to Sam is sort of So companies will either acquire you based off of multiples, or they're going to look at cash flow. And usually they're going to do both of these things, because cash flow basically tells me as a buyer, here's what I'm expecting to get back each year, right? So how long would it take me to recoup my investment? And we do it on what's called a going concern basis. It's just a fancy word meaning forever or into perpetuity. And so we're going to project out your cash flows for, whether it's 3-5 years, and then we're going to do some mathematical techniques to simplify things to take into account the year 6 through infinity. But usually we'll value at an enterprise value basis, and then we'll back out whatever debt or preferred equity you have on the books to get to your true equity number. Again, I mentioned you're being valued off free cash flow. These are the most often used definitions of free cash flow in my world. But I do want to point out that there are other definitions of that. So where you might come up with a number, someone else might come up with a slightly different number, but it could be entirely just because of how you define free cash flow. But I've shown you these two. The left side is sort of that enterprise value, meaning debt plus equity version of that definition. And on the right side is really if you were going straight to kind of an equity value number. In theory, you should be able to use either of these and come up to the same number if I just subtract debt on the left side. These are the alternative definitions I talked about. But again, the two on the prior slide are the two that I employ, the majority of the time, day to day. And I've given you an example here. And the only other thing I would point out is this is sort of like the lottery kind of example. Do I take my lump sum now if I made my $200 million Powerball, or do I take the 20-year annuity? You have to take into account time value of money. $1 today is worth way more than $1 tomorrow. And so you can kind of see on that present value factor line, the first number is like 0.9492. So meaning those dollars are only, 95% as effective. But by year 5, they're only 0.6252. I mean, they're only 60% as effective. So the earlier you recoup that cash flow, the higher the value. So I don't want to touch on the asset approach because it's used the most infrequent. But again, I've given a small example here just showing, if an asset holding company that just had cash and marketable securities, and you literally just add them together. And then discounts are highly contested. These are, the notion would be if I'm valuing one share of stock versus, a majority of the stock, then the one share in theory wouldn't have the same per share number or value because that person couldn't change anything. They couldn't change the cost structure. They couldn't really do anything other than vote their one share. And so because they can't enact change, most people accept that there's a discount there. The marketability discount is also employed all the time, and it really hits on the notion of, you can't go to your Vanguard, you can go to your Vanguard account and sell your stocks, but with your business, you can't just hit sell and have, $20 million in your account in 3 business days. Again, you could do an entire hour just on this topic alone, but I just wanted to point out this fact that when you're valuing a private business, you do need to consider these discounts. And so where you might think your number is one place, but when you think with these discounts, it actually could be anywhere from 50 to 30% less. And then I've kind of showed you on this example just where, assuming I've used all those other methods and come up with a $20 million number, with 10,000 shares outstanding, I then start backing out these discounts for lack of control or lack of marketability because I'm valuing just a 1 unit interest. So you can see how it starts to haircut that value from, over $2,000 to only, almost 1,500. And so I'll end with this quote. I think it does a really good job at hitting home some of the points we're making. Abe Lincoln once said that you can't escape the responsibility of tomorrow by evading it today. So with that, I'm going to turn it over to Sam, and then I believe we'll do questions at the end.
Okay. So really quickly, I'm going to try to share my screen here. I know we were supposed to wrap up at 10 o'clock, so hopefully y'all can bear with us. I'm going to skip over my case study. Can everyone see my screen? Our panelists, can you see my screen?
Yeah.
Okay, good. So where I'm going to start is just not to be repetitive of what Cherish and David shared, but when we're talking about business succession planning and exit planning, it really needs to be part of the overall business planning for the business. So there's other quadrants in which we work alongside the accountants, attorneys, bankers. We work in business planning in general, but then also the personal planning a lot of times for the business. But for today's purposes, we're going to focus on the quadrant of exit planning. But my point really is that as we're working through some of these other things, the exit planning strategy always needs to be in the back of the business owner's mind as part of the planning and shouldn't be ignored or kicked down the road, as everyone today has mentioned in some way, shape, or form. So David already touched on business valuation, and Cherish spent some time on the buy-sell strategies. And then David had mentioned some exit funding strategies or things that are typically considered. What we do and what we bring to the table as far as a complement to all of these great advisors is helping the business owner really plan through what it is that they want and really be strategic on that exit plan so that whatever they put together from a documentation standpoint and from a financial standpoint aligns to actually provide what it is they want for their families and for their businesses long term. A lot of times when we come in and a buy-sell agreement or operating agreement is put in place, or there's an exit strategy that's written down in some way, shape, or form, it usually does not align with what the business owner actually wants to have happen. And a lot of times it's because it's just outdated. So really quickly, some of the additional steps that you want to make sure that you do, and some of this is reiteration, is to start that planning now. Whether you're in the startup phase and we're thinking we may want to sell this thing in 5 to 10 years, or I've got 15 to 20 years later to really think about retirement. Again, if we have a disability or someone dies prematurely, that could cause a business succession trigger. So just make sure to make time for it, because your business is built on a plan to grow profits. You really need to have that plan for exit strategy. And a lot of clients and customers really prefer working with businesses that have strong business succession in place. Your plan gives those companies that you do business with the confidence and the stability of your business going forward. So then you also just want to make sure that you're clarifying your goals. So when do you want to leave? What's next for you? Who will take over the business? Is it a family member? Is it the employees? How much do you need from the business? What I mean by that, if we're looking at targeting retirement, from a personal planning standpoint, is how much income am I going to need in retirement? And is with all my other savings and this business, is the sale of this going to generate enough so that we can be financially secure down the road? Or if it's we want to go out and invest in other businesses, well, is this going to generate enough capital to be able to do that? Or is it the right time to do it based on that? Achieving your vision also includes just building the plan, right? So again, who is it going to go to? Family members, other owners, or employees, a third party coming in and buying it? Or am I really the business? Do we just need to liquidate this thing? And again, some triggering events, whether it be death or disability, or someone wanting to retire or just get out. The one that's not on here, but I know Cherish had talked about it, is just the divorce of the business owners, which is a more common thing to happen. So just making sure that our business succession plan really takes into account all of those things. And then these are some of the different ways we can fund it. I have a case study, but that'll be in the slides. We won't go into that right now. But as we're working with clients, these are the ways that we can fund that buyout. And it could be deferred compensation to employees. It could be employee stock ownership plan. It could be the gifting the business to a family member, installment notes, installment sales to grantor, trust, a SERP, and a sinking fund, stock bonuses, third-party financing. There's pros and cons to all of these from a liquidity standpoint, a risk standpoint, taxation, all of these things need to be worked through, right? So every business owner is different. There's not one of these that is the silver bullet and the best thing to do. It really just depends on your business and what you want to see happen for yourselves, your families, and your employees, and for your business long term. So, so typically we're working with clients to really strategize on which one of these or which combination of these is the best. Okay, so I'm going to skip over my case study, but we will have that for you. We want to take this time now to answer any questions. Does anyone have any questions out there?
And if you don't, or for some reason you're not able to talk, you can type them in or raise your hand, and we can go ahead and unlock your phone so that we can go ahead and take the question from you. So we have a comment about the presentation today. I'll tell you, I guess one of the biggest questions that I have that I get sometimes from clients is, regarding the different advisors and who should I be talking to, or where should I go to get access to some of this information. And so obviously we're a great resource. We're here to help out. But do your homework, talk to more than, one or three folks, just to make sure that, from a personality perspective, your personalities are in line, and that, you're getting an objective kind of advice from everyone.
I just wanted to thank everybody for attending. We will be sending out a survey and an email, and also we will be sending out the slide deck. So if you don't feel like asking any questions today, we will have our email addresses, and so you can ask us them or just give us a call.
Great. Well, in conclusion then, just to back up what Cherish and David had said, I think the moral of this whole presentation is just to don't go it alone. Make sure that you have a great attorney, you have a great banker, you have a great CPA, especially one that has valuation skills, or at least access to someone like David, and a great financial advisor who works and specializes with business owners and business succession, because not all of them are skilled in that way. And what that will do is help to ensure that the documentation and the funding are coordinated for your overall goals.
Yes, so thank you everybody for attending. We appreciate it, and have a fantastic day.
Wonderful. Thank you.